Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Earlier this month, the Federal Reserve cut interest rates for the first time this year. But did the Fed cut because the conditions allowed, simply pulling back on policy that was too restrictive, or out of necessity, reacting to a weaker economy? And how can you spot the difference while it's actually unfolding in real time? Our next guest says that profits may hold the answer there, a leading indicator that can help cut through some of the noise. Joining us here today to discuss all of this and more, including her top three and bottom three sectors, is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Happy Friday, Denise. Great to see you. Welcome.
Happy Friday, Pamela. It's great to be here. I'm never here on Friday, so I love saying happy Friday.
We're delighted to have you. Let's begin with exactly what's gone on with the economy and ultimately why the Fed cut. I mean, the pivot from Jackson Hole was very much to the discussion of the employment picture, and that seems to be the reason for the cut. But that said, why did they cut? Why did this happen?
Yeah, well, we don't really know. I mean, we know what they said in terms of why they cut, and they think they're cutting because they can, because monetary policy is overly restrictive relative to their employment mandate. But I think the concern in markets, anytime the Federal Reserve is cutting interest rates, you do have to be wary that, hey, half of the time they're cutting because they can, but half of the time that they're cutting, you're actually approaching recession. And with the weak jobs numbers, is that exactly where we're headed? If history is a guide to that, you sort of have two different paths. One where the recession is already discounted. I would argue we have to be open minded that that's exactly what April was. But if not, usually the Federal Reserve can't actually help you on the way into a recession, meaning that more often than not, as much as you would expect interest rates to cushion the blow, it usually doesn't. So again, going back to that, you need to be open-minded that in real time, you don't really know why they're cutting. And in some ways, what they tell you might not be the real answer anyway. So if we look to the data, can we point to something that gives us some sort of signal or a bifurcation of options? And in fact, you can, and it's profits. Only a third of the time that the Fed is cutting interest rates are profits growing above average. So average is around 10 to 15%. And right now we are above those historical averages. That tends to be a really strong starting point. So if you say, let's go back to some historical paradigms and say the Fed cutting because they can, that's double the average market returns historically, versus cutting because they have to. Those are a little bit murkier because you have to grapple with what the market is discounting. So that's a big sort of tip, in the pointing in the direction of the Fed at least cutting because they can.
And within that, why the connection of profits to employment and unemployment? I mean, I guess now that you point us in that direction, you can see the connection. If profits are up, then people are less likely to be fired in those situations. But is that it? You're looking at profitable companies, basically.
Yes, that's exactly right. I mean, I think it's back to sort of the statistics that we always talk about. As much as we as consumers interact with the US economy or any economy via our jobs, right? Our wages and salaries, are we laid off or not? So we tend to think that that is the most important thing as it relates to the overall economy, and therefore as it relates to stocks. But what you can very clearly see in the data is if you use that as your investment discipline to either buy or sell equities, it can lead you very astray because it's statistically a lagging indicator. So what you see is the worse payrolls have been historically, or the worse the revision has been historically, the more likely stocks are to go up over the next 12 months, not down. The relationship is linear. So again, I can't give you 100% odds, but what I can tell you is that, there's a whole lot of historical data saying, don't look at that, because it's not going to help you make investment decisions. So then the question is, well, what should we look at? Because if we think jobs are important, what's the leading indicator of jobs? And here we see the same historic relationship, meaning that it's linear. The more you see profits grow, the more you go across the quartile of growth spectrum, the more likely jobs are to accelerate over the next year. And that makes a whole lot of intuitive sense because if corporate America is more profitable, then they're probably more likely to hire rather than fire. So again, there are no guarantees, there are no certainties, but what I can say is that when I see data that has these historical patterns, I tend to lean in that direction. So I don't think it's an accident that the market is hitting all-time highs when the Fed is cutting interest rates. And it's around this because profits as a starting point are very strong, which might suggest, again, if history is a guide, that the softness we're seeing in payrolls is a soft patch that then resurges over the course of the next 12 to 18 months.
So it's already happened, as you say, it's lagging. I mean, do we think that the Fed chair and those voting on the FOMC are telling us a slightly different narrative? I mean, they're obviously seeing profits are up. So why are they telling us maybe something different? I mean, it doesn't really matter, I guess, in the end, but it seems like they would have the same info to make that decision on.
Yeah, I'm not sure that they would ever make the decision based on profitability of companies as much as they're statisticians. I think that that's well with outside their benchmark. I mean, at the end of the day, I'm not buying and selling units of GDP like they are. I'm buying and selling units of stock or, equity investments. So, the relationships that I see in the data is less relevant to them, right? I'm talking about stocks and stock market as it relates to that. But look, I mean, it might be the rationale behind why they're not making 50 basis point cuts. We don't really know, right? I don't think that they're particularly transparent, or at least, maybe other people feel differently, but I do read the Fed minutes and I don't find them particularly transparent. So in terms of their economic models, I'm not sure that we have the full picture. But what they have said is, look, we think we can cut because our employment mandate is a little bit weaker than we expected, but we don't think that we need to cut with haste because we don't think that the economy is weakening quickly, right? In some ways, that might be a function of, well, if corporate America is profitable, then we're seeing weak growth in terms of jobs, but we expect it not to be persistent. So maybe that's the exact reason why you see a bunch of 25 basis point cuts instead of a bunch of 50 basis point cuts.
Well, and of course, there was one member voting for a 50% cut. We know that was Stephen Mirren, and we knew that he literally flew into that position just in time to vote. But he also made some comments around it. I'm curious, there's much discussion about Fed independence. What do you think about what he said and the reasons for, in his mind, a 50 basis point cut?
Yeah, I found it fascinating. Back to what we just were talking about, which is I find the Fed, for me, and again, this is Denise Chisholm's opinion, not to be particularly transparent on why they do what they do and how they see the economy playing out. He laid out a very cohesive view that you could, argue with, you could debate about, which is very rare from a Fed policy, somebody on the FOMC. So it's interesting that you saw that. But from my takeaway, and again, he said a lot in terms of the information of why he would recommend a 50 basis point cut. But one of the reasons was because our star is lower, right? Our star is your normalized run rate of growth, what you think that the underlying growth rate of the US economy is. And in some ways, like that makes a ton of sense to consider when you're thinking about policy, because you're going to have a different interest rate on a nominal basis if you think the run rate of your economy is growing at 2% versus you think it's 4%, right? That's going to be very different structurally. That's why that we always have to struggle with what neutral is and there should be a proportionality between your nominal interest rate and the underlying growth rate that you think that the US economy can achieve. And the interesting part is that he said, I think we should cut interest rates more because the underlying growth rate to the US economy is weaker than we thought. So that's my interpretation. I think that there is some debate of the interpretation of those views around the savings and investment and CapEx expenditure, maybe changing the dynamic behind that. But look, I mean, to the extent that our star is lower, then interest rates can come down, but that might not actually be the most beneficial setup for the US equity market. Remember, I always say that you have to step back and look at the data. When you look at interest rates, both on a nominal and real basis, more often than not, higher rates are a reflection of growth rather than a deterrent to it. And more often than not, that's a good thing for US stocks. So be careful when you say as an investor, we want lower rates. Maybe you want marginally lower rates because we don't need to be overly restrictive, but we don't want lower rates in size because usually, to his point, it's a reflection of a much lower growth rate. So I don't know that we'll get there, but I thought it was an interesting twist on why you want lower interest rates.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
He also talked about tariffs. He talked about different aspects of what tariffs do to an economy, and ultimately, does that then require lower interest rates? There were some other pieces that he added into that. I mean, I'm kind of curious what you thought about some of those pieces of the story. It goes back to the Fed independence. It sounds a lot like the talking points from the administration, but again, they are points to be discussed. What did you think?
Yeah, so to me, it reminded me of being back in college and studying econ. Probably this is 401, not 101, but it was all around that savings and investment and rebalancing global trade to make us less of a consumption economy and more of an investment and savings economy. And the math around that says that you do not need rates as high, right? So that's what I mean by he thinks our star is lower, in part because the underlying growth rate is lower, but in part because we will now be savers and investors rather than consumers. That to me is very theoretical. So far, you haven't seen that in the data as it relates to tariffs. And I think for me, it's a bridge too far. So I like to see, when I see theoretical math, I would like to be able to prove it in the historical data. And that's something I think that we haven't seen yet in the United States. What I do think, and you know, is that I think tariffs are a tax, not necessarily an impetus for a generalized rise in the overall price level. And because of that, I think that they will not really cause sustained and persistent inflation, which is back to that Fed cutting because they can, because they expected that tariffs would lead to a resurgence in the overall price levels that you are just not seeing, or not seeing in the magnitude that they thought, which means that you don't need to keep policy so restrictive, which means that you can lower interest rates, and it means that inflation is probably more likely persistently lower. Will it be 2% again? Probably not, because that's well below median levels historically. But it doesn't mean that inflation is going to resurge to 4.5%, which is the problem point for equities. So if we don't enter the problem point for equities, even if we don't get back to 2% inflation, we're in the sweet spot. So interestingly enough, I mean, despite tariffs, we still have inflation in the sweet spot for positive equity returns.
Fascinating. It's fascinating how that's worked. Let's go into the tech company.
Yes.
Okay.
Yeah.
Perfect.
So technology is leadership. I do think that is the sort of the bullet point from all of the macro pictures that we're talking about, the Fed cutting interest rates. Why? Because they can. So how does all these probabilities sort of lead you to what to own as an investor? And I think that all of that math tilts you towards economically sensitive sectors. So I think if the first slice of what do I own in this environment it's do I want to own defense, like consumer staples, utilities, healthcare, energy, or do I want to lean towards cyclicality? I argue that you want to lean towards cyclicality. So technology looks like leadership to me based on the fundamentals. Yes, they've snapped back in terms of valuation, so they're not nearly as cheap as they were in April, but not snapped back to the extent that they are as expensive as they were going into sort of the beginning of the year either. And that has set us up for a better risk reward. So I do think that you have the dual tailwinds still existing in technology stocks, meaning that I think that earnings growth is strong and likely getting stronger as a result of the tax cut. Free cash flow growth is very solid, plus the fact that I think you could even get more multiple expansion back to those peak multiples. Because remember, to me, statistically, expensive stocks or sectors or the market is only just saying that I think earnings growth is more visible. And I do think that you have that in triplicate in technology stocks.
It's really interesting. Do you think that the tech companies themselves, and along with the rest of corporate America, is going to get sort of more efficient without having to do layoffs? That's almost aside from the profits side of the equation. But do you think just within that the layoffs maybe don't need to be, I don't know, as bad as feared because it can be worked inside the companies themselves to sort of make things more productive for individuals?
No, that's an excellent point. And I think it's not just true of technology companies in America, it's true of most of our corporates. I mean, when you think about how efficient they've been at full employment, labor doesn't need to be the flex. And we lived through the cost shocks as it related to the pandemic and now tariffs. And you're seeing the flexibility of corporate supply chains to be able to squeeze costs, to make them more efficient, to then be able to sustain full employment. So it's back to that, what we talked about. There's a reason why there's a relationship between profitability and payrolls. So I do think that the productivity as it relates to corporate America and the efficiencies that they've gained and the flexibility around the supply chains has just set up for a much better risk reward from an economic recovery perspective.
Just quickly before we go, a couple of thoughts on data. It seems like the data question has been a bit cracked open. There's some concern about the BLS, the survey itself, those collecting the data, there's going to be reform and so on. What should we think here? Is it an opportunity to get better data? This is what you look at all day, and inform us on how we should look at it. What is sort of the outcome of the fact that there's been a big bust up over the data?
Well, I think it's important to know that there is no correct data, right? There is a gold standard number, right? These are all estimates. This is a very large, quickly moving economy. So there are benefits and risks associated with any calculation. Can the calculations get better? Absolutely. I mean, one of the trickiest issues with the BLS is that the response rate of the people who report in for the non-farm payroll numbers has drifted massively lower, not just marginally lower, but massively lower. And they haven't really taken any steps to rectify that response rate. But we have seen revisions always be a problem because there's always going to be some slice of data, some slice of non-farm payroll employment people that haven't reported the data yet. They're the people that are disproportionately struggling. So when a shock hits the US economy, you usually see revisions after the fact. And that is one of the trickiest issues around defining recessions, is because by the time you know you're in a recession, you've already been in one, right? And more likely it's discounted with stocks. That's why it's always tricky from an investment perspective. But theoretically speaking, policymakers know that. There is a trade-off between smooth data that policymakers can correctly interpret that gives up a little bit of accuracy for very volatile data that might be, quote, more accurate, but less able to be read by policymakers. So there's that trade-off as well. So look, I think at the end of the day, there's a whole lot of data points as it relates to the job market or the US economy overall. And it's not just the science and the data. It's the art of the interpretation of not only the collection of data, but the interpretation of it. And I think that even if you made data and data collection better, I think you would always have that debate around interpretation. So as much as we can make it better, I don't think it'll be any different in the next cycle. We'll still be arguing about the same stuff. And from an investment point of view, the thing that you always need to remember is that a lot of these things that you're arguing about are lagging indicators as it relates to stocks.
And as much of the concerns are already priced in. I've always thought that your reports are artwork-like, so that actually makes a lot of sense. So just quickly, as we close out, bottom three sectors for you. You mentioned tech at the top as leadership, so bottom three.
Yeah, so top three: technology, consumer discretionary, specifically home builders, and then financials, specifically within that brokers and capital markets, which I like. Bottom three, without a doubt, now utilities would be my top sector to pick on. I think that the risk reward is deeply negative there. After that, it would be energy, and after that, it would be consumer staples.
Consumer staples. Amazing. Denise Chisholm, we are so grateful to have you here to round out the week. We do apologize for the technical difficulties. Those are on my part, and I am very, very sorry about that. But Denise, you are a superstar as always. Have a great weekend ahead.
Great to be here.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.